welcome to Hilltop Wealth Advisors Economic and Market Update for the fourth quarter of 2020, or the season finale, as some might call it. I'm Chris Hostetler, and here today with Brittany Mollica. Brittany, we have some big issues to discuss, don't we?
We sure do. So let's get into it. The main topic for this year is, of course, COVID-19. And as of early November, we have had over 230,000 deaths in the United States. But taking a look back at things, of course, in March, we saw the stock market dramatically fall as the world began to realize the implications of a global pandemic. But then almost immediately afterwards, we had an impressive rebound in the stock market. The S&P 500 had its best 100-day rally in stock market history. And a lot of that was fueled initially by quick action from the federal government with fiscal stimulus programs, and also with the Federal Reserve quickly cutting interest rates. But more recently, this recovery has been supported by positive economic data. The manufacturing sector, for example, has had strong numbers, and U.S. consumers generally seem to be doing well also with consumer spending and consumer sentiment. So we had seen cases stabilize for a while, but more recently, there's been a notable uptick in new COVID cases and hospitalizations. And in reacting to that, there's definitely a balance between not wanting the economy to slow down again, more people losing their jobs, their businesses closing, but also definitely not wanting to see COVID cases continue to increase. So we really recognize that the people having to make policy decisions right now don't have easy decisions to make. These are definitely hard times. Fortunately, at least, the death rate has not risen in line with the new COVID case rate. And also over the past few months, we've certainly gotten better at treating the symptoms for the virus while we're waiting for a vaccine.
Yeah, and speaking of waiting, let's talk about the big news of the moment, which is the election. As we film today, it is the day after the election, and results are murky, to say the least. As investors, we crave certainty, but in the hotly contested presidential race between Donald Trump and Joe Biden, there are still a lot of unknowns. There are currently several states running neck and neck, including our home state of North Carolina. And as we await final results over the next few days, maybe weeks, it's likely that the market could go through several gyrations. And you've heard this from us many times, but it's a more important reminder than ever. On the whole, the market doesn't seem to care whether the White House is in the hands of Democrats or Republicans. But investors in the market do want to know what the national policy will be so they can make calculated bets in the right sectors and on the right companies. So let's indulge ourselves for just a moment and think about what either result might mean. It's assumed that a Biden win would be good for infrastructure investments, such as construction and transportation firms, along with industrials, energy, and materials sectors. But a Biden win would also likely come with more regulation and higher corporate taxes. Trump winning, on the other hand, would be expected to benefit oil and other energy firms, along with financial, healthcare, and defense sectors. On the economically negative side of a Trump win, we'd also expect ongoing concerns and murkiness in international trade policy. But these are only our educated guesses, and any sector bets in your portfolio would only be based on short-term movements. We like to focus on the long run, where it's the economic fundamentals that drive growth. We caution you against trying to bet your money based on political outcomes. Because once it becomes certain that one candidate or another will win the election, the market will absorb that information and shift more quickly than what you can do in your balanced portfolio. So we need to be aware of the impact of short-term volatility, but we still allocate our portfolios based on longer-term trends of economic health and profitability. So Brittany, maybe you can talk a little bit about what those trends are.
Yeah, definitely. So like Chris was saying, despite the focus in the news on COVID and politics, we really spend a lot more of our time studying economic data. That gives us a much better sense of the long-term trajectory of where we're headed. And like Chris also mentioned, things have been pretty positive for the past few months. GDP, which was down 31% in the second quarter, bounced up 33% in the third quarter, and unemployment fell to 7.9% at the end of September, which means just over 12.6 million people were unemployed. And don't get us wrong, these are staggering numbers, but they're certainly trends in the right direction. Like I mentioned earlier, there's also been strength in the manufacturing sector and with the US consumer. However, going forward, we do think the future pace of the recovery is bound to be slower. We'll probably need more fiscal stimulus measures, especially to support certain sectors of the economy. We'll also hope that the Fed will continue to remain supportive. They have mentioned that they don't plan to raise interest rates for the foreseeable future, and they'll also allow inflation to creep up higher than they usually do. So we don't expect any changes to interest rates anytime soon. However, we really won't see a full economic recovery or a return to a new post-COVID normal until there's a vaccine that's approved and able to be widely distributed. And even at that point, we'll likely see the federal programs start to slowly dry up, and that might mean difficulty for a lot of Americans that had been relying so heavily on those programs. So all of that to say, the economic data shows us that we have really recovered a lot, but we are still not where we were pre-COVID.
That's right. So let's address our portfolio positioning. Most important message, and I know we sound like broken records, but we say this over and over again because it's so important. Stay invested and stay diversified. The market moves very quickly, and it can drop suddenly, it can recover suddenly. So we don't want to try to find the top or the bottom of the market. But in addition to the election and COVID situations, we are watching some other notable risks as we position our clients' portfolios. We're still paying attention to trade tensions with China, and we're still concerned about the possibility of an ongoing and messy Brexit. Now, in our model portfolios and the accounts that we manage, with trades that we did in 2019 and at the beginning of this year, we had positioned portfolios somewhat defensively. And with all of the risks that we've already discussed today, we still have some of these protective holdings in our portfolio. But we're mapping out some trades that allow us to position in a slightly more conventional way, which would be more aggressive than our current positioning. And we actually did this back in May, closer to the bottom of the market after the big drops in February and March. And that move to a slightly more aggressive portfolio at that time has helped us during the recovery this year. For now, we're just waiting to have a bit more certainty on some of these broader issues before we make these additional trades at this point.
Thank you, Chris. And thank you all for watching. We hope you've enjoyed this and learned something. We are always happy to talk. And if you're looking for more information, you can check out our website and the Hilltop Views blog.